The world's biggest economy, the United States, may be on the up, but global markets still want its central bank to print more money. But there were no such promises from the Federal Reserve Chairman Ben Bernanke when he faced Congress. While he enjoyed the fruits of his stimulus, his counterparts across the Atlantic were busy pumping billions more into their banking system. Here's Philip Lasker.
With the European threat subsiding, global markets were free to focus on US Federal Reserve Chairman Ben Bernanke, who declared his spending spree was gaining traction.
The decline in unemployment rate over the past year has been somewhat more rapid than might have been expected.
But in typical central banker style, he cautioned against irrational exuberance.
The job market does remain far from normal. The unemployment rate remains elevated.
Despite that, Ben Bernanke wasn't offering to rev up the economy by printing more money.
He doesn't want that to really fan the inflation flames, of course, but by the same token, he doesn't want to overplay his hand in terms of the momentum of recovery.
Commodity prices, including gold and equity markets, sold off.
I suspect that people were just saying, well, we really want the US economy to fire a bit faster, because if you're growing at 2.5% to 3%, which is what he's sort of saying he's expecting to happen, that's really not going to lower unemployment much.
But running too slowly isn't China's problem, with the latest manufacturing data showing 3 straight months of improvement.
It means that the economy is pretty well positioned for a perfect 3-point landing in terms of a soft landing scenario.
Some of the stimulatory policy that the central bank, by lowering the amount of reserve banks have to hold, is starting to help.
And in Europe, where they're stabilising, not stimulating, the European Central Bank pumped an extra €500 billion into the banking system.